So another item that we will consider in our audit report would be the impact of the subsequent events. So we already know from our discussion last time in completing the audit that subsequent events, so these are the events that occur after the date of the reporting period. So for example, for a calendar year company, December 31, so up to the financial statements are issued by the company. Okay? Now, you also discussed this in your intermediate accounting course. So particularly intermediate accounting part 3. So because you have to determine the implication of the subsequent events on the financial statements before the company issues their financial statements to the public. So we have two types. Now the first one, the type 1 events, also known as adjusting events. So events that provide additional evidence, so with respect to conditions that are already existing as of the end of the reporting period. So that is why they are called adjusting event. Now for example, let's say on December 31, the client recognized a provision which is an estimated liability. And then after year end, but before the financial statements were issued, so there was an evidence about the actual amount of the liability recognized last December 31. So the amount was confirmed. So in that case, since the financial statements are not yet issued, so there's still an opportunity for the entity to reflect the actual amount as of December 31, for example, as of year end. So with respect to that liability. So in that case, that is considered as an adjusting event. So what the company would do, what the client would do, would be to revise the amount originally used in the financial statements December 31 to reflect the actual or the correct amount of liability as of December 31. So usually that would not require disclosure. So because in the first place, you had better evidence about the amount as of December 31. So therefore, the amount to be presented would be as if you had known the amount as of December 31 already. So that is why you are replacing the estimate with the actual amount because of the additional evidence about the liability that occurred after December 31. So in contrast, when we say type 2 events, so these are the non-adjusting events that provide evidence with respect to conditions that arose subsequent to the reporting period. Now, unlike in type 1 event, in my example earlier, the liability already exists as of December 31. What just happened in the subsequent period is that you were able, or the client, the company were able to confirm the actual amount of the liability that already existed as of December 31. But for type 2 events, so these are the events that provide evidence with respect to conditions that arose after the reporting period. So let's say a catastrophe damaged the company's facility after December 31. So as of December 31, the amount of the PP of the client would not be affected. So because as of December 31, the catastrophe, for example, has not happened yet. However, after December 31, so let's say the catastrophe destroyed their building or their facility, so before the financial statements are issued, so that is an important information that should be made known to the users of the financial statement. So therefore, the financial statements will be updated, there will be a disclosure about that event, but the amount presented as PPE will no longer be affected. So therefore, it will not result to adjustment, but only disclosure. So as far as we are concerned, auditor, we have to consider whether those events are properly accounted for and adequately disclosed in the financial statements. So to sum up, we are responsible to perform subsequent review, so up to the date of the auditor's report. So from year end, for example, December 31 for a calendar year company, up to the date of our auditor's report. So that is why in completing the audit, we mentioned that the date of the auditor's report, that is the last day that we will perform our audit procedures. So we discussed there, in our completing the audit, some of the procedures that we perform. So during this part, like for example, inquiries with management and asking for their minutes of meetings of the board, shareholders between December 31 year end up to the date of the audit report. Now, after the date of the auditor's report, we do not have any responsibility to perform procedures anymore, so related to subsequent events, but it is the responsibility of the management to inform us now of any facts that could impact or affect the financial statements after the date of the audit report. Okay? So if there is additional information so that could affect the financial statement, so it's the responsibility already of the management to inform us if those events occurred after the audit report date. Now, because our procedure with respect to subsequent events only extend up to the date of the audit report. Now, for example, so let's say, so between the date of the financial statements, so in this example, December 31, 20X1, up to the date of the auditor's report, March 31, 20X2, we perform a subsequent events review. So therefore, if there is type 1 event and type 2 event, they will be properly reflected in the financial statements. For example, there is a adjusting event, then amount would be updated, no, on the financial statements before the financial statements are issued. Okay? Or if there is a non-adjusting event, so the information will be disclosed before the financial statements are issued. Okay? Now, the issue here is that, let us say that the date of the audit report is March 31, 20X2. And the financial statements are expected to be issued to the public on March 12, 20X2. Or sorry, April 12, 20X2. So normally, the procedure in issuing the financial statement is that the management first approves the financial statement, then we issue our audit report. So remember, the issuance of audit report cannot be earlier from the date the financial statements are approved by the management. Now, in practice, normally, the date would also coincide the date of the auditor's report. Okay, but the audit report date cannot be earlier. So, for example, the management approved the financial statements for issue on March 31, 20X2. So, by approve, it means the board of directors adopted a resolution approving the financial statement, signing the financial statement, and issuing the auditor a written representation letter, so which we discussed in completing the audit. And in exchange for the written representation letter from the management, so we will issue our audit report, which would coincide also the same date, so let's say March 31, 20X2. However, the financial statements will not yet be released to the public. So usually there will be some time before the financial statement are issued to the public. So like for example, in this case, although the approval of the financial statement and the date of the audit report is March 31, so the financial statements were issued to the public April 12, 20X2. Now, what if there's additional subsequent event that occurred after the date of the audit report but before the financial statements are issued? So our procedure as auditor, let's say in this case, the audit report date is originally March 31, then there's a subsequent event discovered on April 10, 20X2. So our procedure is that we have to consider whether the financial statements need amendment. Okay? So, and if the financial statements need amendment, so meaning to say there are figures that need to be changed or additional disclosures that should be included, then we have to carry out necessary procedures and issue a new audit report. Okay? So therefore, for example, the client amended the financial statements, approve it, we will obtain a new written representation letter, so including the subsequent event, and we will issue our new audit report. So our new audit report date will be April 10, 20X2. So in that case, our new audit report should not be dated earlier than the amended financial statements are signed or approved by the management and those charged with governance. So meaning to say, if let's say the subsequent event was discovered on April 10, 20X2 and the management approved the financial statements to be amended on the same date, so we cannot issue our audit report date earlier than that date. So if the management approved it in April 10, our audit report date should be dated April 10 or later. Cannot be earlier. And then as a consequence, what will happen is that we'll have to extend our subsequent event review. So because originally, our subsequent event review is only up to March 31, the original report date. But because of the subsequent event, we'll have to extend our subsequent event review up to April 10, 20x2. But there is an alternative. No? An alternative is to dual date our report. So in dual dating our report, we will keep the original audit report date, March 31, 20x2, so except to the specific subsequent event. So our new audit report date will only pertain to the subsequent event that was discovered on this date. So in that case, we can limit our responsibility with respect to performance of subsequent event review. So because if we did not dual date our report, what will happen is that we'll have to perform subsequent event review on all other matters up to April 10, 20x2. But if we dual date our report, we will only extend our subsequent event review to the specific subsequent event occurring after the original audit report date. But let's say, what if the client refused to amend the financial statement? So let's say there's a subsequent event discovered on April 10, 20x2, but the management do not want to update or amend the financial statement. In that case, that is equivalent to what? Material misstatement. So if the management would not want to revise or amend the financial statement, then we'll have to express a qualified or adverse opinion. So we'll replace our audit report with one with qualified or adverse opinion. Okay, so especially if we haven't given yet the audit report, the copy of the audit report to the client. So because it's possible that the audit report is dated March 31, but we haven't physically released the audit report to the client. In that case, we still have an opportunity to change our audit opinion, to qualified or adverse one, especially if the client would not want to amend the financial statement. But the problem arises, so when our audit report has already been released to the entity. So if it has already been released to the entity, then we have to notify those persons ultimately responsible for the overall direction of the entity. For example, their president or their chairman, not to issue the financial statements and the audit report to third parties, considering that the financial statements is now discovered to contain material misstatement. Okay? However, if the financial statements are subsequently released, so regardless of our instruction, the client is still released the financial statements containing the original audit report, not the new audit report. So we have to take action to prevent reliance on our audit report. Okay? But our action would depend on our legal rights and obligation and recommendation of our legal counsel. Okay? Because we'll have to, for example, send a message or send a statement to, let's say, SEC and BIR that the public should not rely on the report that the client issued. But that is just an example. So ultimately, our action taken will depend on the recommendation of our lawyer. So in case the client does not want to amend the financial statement. Okay? Now, what if there are facts made known to auditor after the financial statements have been issued? So earlier, the subsequent event occurred after the date of the audit report but before the financial statements are issued. Now, in my example earlier, the subsequent occurred on April 10, on this period or on this part. So between the original audit report date and the date the financial statements are issued. Now, in this another scenario, what if the subsequent event occurred after the date the financial statements are issued? Like in this case, April 15, 20x2. So the problem here is that the financial statements are already released to the public. Okay? So if we become aware of fact which existed at the date of the audit report and which, if known at any date, may have caused the auditor to modify the auditor's report, so this will be the courses of action of the auditor. So meaning guys, the subsequent event was only discovered April 15, 20x2, but the matter has already been existing on March 31, 20x2, or as of the date of audit report. Okay, and had we known that information as of this date, so we would have modified our audit opinion. Okay, so in this case, we have to consider whether the financial statements need revision or not. And if it needs revision, then we have to carry out the necessary audit procedures, review the steps taken by management to ensure that anyone in receipt of the previously issued financial statement, together with our original audit report, is informed of the situation, and then issue a new revised financial statements together with the new audit report. Now, take note in this case, the responsibility to notify the person or persons who receive the financial statement and the original audit report, the responsibility rests with the management. So the management should notify everyone who received the original FS together with the original audit report not to rely anymore on those financial statements and reports. So because the management will issue a revised FS. Okay? So in that case, once the management issue a revised financial statement, we will also issue a new audit report. So our new audit report this time will include an emphasis of matter paragraph. Okay? So referring to a note discussing the reason for the revision of a previously issued financial statements to which we issued an original audit report. So notice the difference. Earlier, if the subsequent event was discovered before the financial statements are issued, no need to add emphasis of matter paragraph. Okay? So, no need to add emphasis of matter paragraph. So, because end of day, the financial statements are not yet known to the public at that time. So, because it's before FS issuance. So, therefore, the amended financial statement and the audit report will be seen by the users for the first time. So, no issue with regards to that. But in this scenario, the difference is that the financial statements were originally issued to the public already. So that is why when we issue a revised audit report, this time we have to inform the user about the details of the revision. That is why we'll have to add an emphasis of matter paragraph in our audit report. And of course, so this is useful. The new audit report will not be dated earlier than the revised financial statements are approved. So if the financial statement are approved April 15, so our new audit report should not be dated earlier than April 15. Okay? And then normally our subsequent event review will now need to be extended up to the date of the new auditor's report. So originally our subsequent event review is only up to March 31, 20x2. Now because of the subsequent event, we need to extend our subsequent event review up to April 15, 20x2. But this time, this responsibility is also different. So because this time, the PSA allows or permit the auditor to restrict the audit procedure regarding the revised financial statement to the effect of that subsequent event. So we can limit our subsequent event review with respect to the subsequent event that was discovered on April 15, 20x2. Now, unlike earlier, if the subsequent event was discovered before the financial statements are issued on April 12, 20x2, our subsequent event responsibility will cover all subsequent events, not just limited to the subsequent event that was discovered on this date. So, but if the subsequent event was discovered after the financial statements are issued, we are permitted to limit our review to the specific subsequent event that occurred or that was discovered after the date that the financial statements are issued. Now, another issue, what if the client did not want to revise the financial statement? So, meaning the event was discovered after the financial statements are issued, we carry out our procedures related to that subsequent event, and we have concluded that the financial statement should be revised, but the client refused to revise it. So in that case, we'll have to notify those persons ultimately responsible for overall direction of the entity, like the management, those charged with governance, their president, that we will take action to prevent future reliance on the audit report. Okay, but again, those actions will depend on our legal rights and obligation and the recommendation of our lawyers. However, it's also possible that revision might not be necessary at all if the issue of the next financial statement is already imminent. So let's say the client will issue an interim financial statement, so let's say on June 30, then it's possible that revised financial statements will no longer be needed to be issued anymore. So provided that in the next financial statement, there will be an appropriate disclosure that will be made regarding to that subsequent event. Now, related discussion on the subsequent event is dual dating of the report. Now, as mentioned earlier, dual dating supplements the original audit report with a current date, specifically limiting to the note describing the subsequent event. Now, like for example, the audit report date is March 31, 20x1, the original audit report date, except as to note 6, so which pertain to the subsequent event discovered on April 10, 20x1. So in this case, our subsequent event review will be limited to the specific subsequent event that was discovered on April 10. So because if you will not dual date your report, what will happen is that you will be responsible for all subsequent event, to review all subsequent event, not just the subsequent event discovered on April 10, but all subsequent event again up to April 10, 20x1, instead of just March 31, 20x1.